Hello, everybody. We're just going to wait a few minutes to get started as people join the webinar. So welcome, everybody. We'll just wait just a couple minutes. I see people flowing in. We're waiting just a few minutes to allow people to, for those of you eating at your desks or in the comfort of your home, give people a chance to get their lunches if they're eating and get situated for today's webinar. Okay, I think we're gonna go ahead and get started today. First off, I want to welcome everybody. My name is Melissa Van Diepen, and I am the Chief Philanthropy Officer here at Stanislaus Community Foundation. And we're really grateful that you are here with us today and that our advisor of SCF's family of funds is here as well to share some insights with you. So just some general housekeeping items. Once this is completed, we are going to send out a recording and a slide deck to you so that you can review. And I know there were people that registered that couldn't join real time that wanted to make sure they got that recording when we're done today. We're also going to be sending out a survey at the end of the webinar. So please be on the lookout for that. We're always open and welcome feedback from all of you as we do these periodic briefings. And then lastly, if you'd like we can see names of attendees, but if you'd like to identify yourself and the organization that you're with, that would be excellent as well. So with that, I am going to hand it off to our president and CEO here at Stanislaus Community Foundation, Marianne Cannon.
Thanks, Melissa. Welcome, everyone. It's so nice to see your names pop up. And when Melissa and our team first developed this webinar, we really wanted to ensure that we were providing you real-time information on the state of the markets, as Melissa said, given that our assets are invested and we know there's been a lot of volatility. And so we're here really to talk to you today with Jennifer's presentation about how we're approaching what's happening in the markets and also what we're learning and gleaning from that. But really this webinar is for our professional advisors, our CPAs, attorneys, financial advisors that help those in our community with their assets, whether those assets are invested through the community foundation or not. So this is really good information for those of you that are on the call that are attorneys and CPAs and professional advisors. I also see some of our donors on the call, and that's wonderful because I know we fielded several questions from donors on what is happening with the portfolio that the Community Foundation manages on behalf of multiple donors. And it is important to us that we safeguard and steward those charitable resources, because those charitable resources, as the donors are in our call know, really are being put out into the community to support local nonprofits, local initiatives, scholarships. So we take our management of these charitable assets very seriously. And so today is about really getting on the same page about what's happening and also how the Community Foundation approaches and safeguards our charitable assets on behalf of donors. So we'll provide the market overview. You will have a chance to ask Q&A through the chat that Melissa will moderate. And then I'd like to end the call by telling you a little bit about our leadership portfolio that's obviously separate of our investment portfolio, but we also take the work we do out in the community very seriously. And so I'll just give you a very brief update on that work. So next slide, please. I mentioned the Community Foundation. For those of you that aren't familiar with us, We are a place-based philanthropic organization, a 501c3, but unlike any other nonprofit in the community, our main goal is to ensure that individuals, families, corporations are investing back into the community using their charitable wealth. And so we transform those local resources into common good here locally through grants to nonprofits, scholarships to students. So far, we're actually celebrating our 20-year anniversary this year. We've invested more than $35 million through a whole number of families and individuals and corporations, again, out to local causes and organizations and students. That money that we're putting back out in the community is, we have 175 funds. We have a family of funds, all again set up by different local folks and comprising about $47 million in assets under management to date. So we've grown over the years, very proud of our growth in terms of our asset and our pool, but also I'm just as proud of the fact that we've actually tripled our giving in this community in the last 5 to 7 years. And that's very exciting. So more money being invested, more money growing, more money going out. So we want to see more of all of those things. And I just want to point out that over 90% of the funds under management for us are donor directed. Some of those donors are on the call or designated for scholarships and specific programs. So next slide, please. And I'd like to now introduce Jennifer Ellison. For those of you that have had the pleasure of hearing Jennifer speak at one of our fundholder breakfasts, I always am sort of flabbergasted at the depth and breadth of Jennifer's knowledge, not just on sort of the markets, but what really is feeding what's happening in the market. She provides such insight, and she is part of Cerity Partners Silicon Valley office. She manages our investment portfolio. So again, multiple individuals and families through the Community Foundation rely on Jennifer's expertise to shepherd these funds well into the future. We're playing the long game here, folks. And so how do we build what I call a community's treasure chest or war chest over time so that we can, again, continue to invest those assets? And I know Jennifer takes that work very seriously. And so I'm going to turn it over to her to share her knowledge. Jennifer.
Thanks, Marianne. I plan to speak for the next 30 minutes roughly about what's driving the economy and how that's translating to the markets and down onto the portfolio for the Community Foundation. So I'm going to start with the first slide. I've got a number of slides here. Please put your questions in the chat. I'll take as many as I can towards the end. And if we don't get to them, I'm happy to take them offline as well. But the theme of really what's been going on in the economy and the markets this year and last really has been inflation. This chart looks at inflation, the inflation rate going back to the early 70s, when of course inflation was really high. And then we've gone through a period where it's been quite a bit lower, but it spiked in the at the beginning of the pandemic mostly because the supply chain was shut down, but demand for certain things was quite high. We were home, we got stimulus checks to spend, we were ordering from Amazon. How we spent really changed from maybe dinners out and travel to, a new phone or computer. And that caused prices to go up because the supplies to make those things were stuck in ports. But that was all expected to start to roll over after the economy reopened and we all resumed sort of normal activities until February of this year, when China shut down their ports because they were having a COVID surge and Russia invaded Ukraine at almost the same time. And that sent the markets into a spiral. Inflation went up, the supply chain had a stranglehold once again, and inflation continued to rise from there. The next chart puts inflation into a historic perspective. We've been through periods in the last 100+ years of very high inflation, generally following wars, the World War I, World War II. We've had a period of deflation during the Depression, which is even worse than a period of high inflation. We've had the 70s and 80s when you might remember that inflation was in the mid-teens and getting a mortgage at that point would have cost you 11 or 12%. But we've been through 20+ years of relatively low inflation. We've got a generation of folks who don't understand what it means to have the price of something you want to buy go up pretty rapidly in a short period of time. So this is new for the last 20 plus years. Next slide looks at, what do we do about this? So the Federal Reserve is really in charge of managing a certain part of the economy. They have what's called a dual mandate. Their job is to keep inflation in check and keep people employed, keep the economy at full employment. The top dark blue line on this looks at the historic inflation rate, going back to 2002 in this chart. Labor conditions, you see, that got very interesting in a bad way in 2008 during the financial crisis, when lots of people lost their jobs and the unemployment rate went way up. And then again in the pandemic, when tons of people lost their jobs because their businesses were closed. But we've recovered back from all of that, and we are back now to a historically low unemployment rate, historically high number of people working. Now, the Fed, the tool the Fed has to manipulate these things to the best of their abilities is what's called the Fed funds rate, or the interest rate that they set. It's a very short-term interest rate, but it's the interest rate that banks lend and borrow at, but it drives things like mortgage rates and credit card rates. And to put it simply, if interest rates are higher, if your mortgage costs you more, you have less money to spend on other things. And so in theory, if they raise interest rates, they're taking some money out of the system, and that should bring inflation down because demand will come down. So they started this process. The next chart looks at the path they currently intend to take to get interest rates higher. So this chart is looking at the Fed funds rate. It was at zero for a long time after the financial crisis, and they had started to bring it back up to a more normal pace. I distinctly remember the conversation I had with the Community Foundation Investment Committee in early 2020 about, sort of what risks we saw for the market going into that year. And the big risk that everybody was talking about was that the Fed might send the economy into a recession if they were too aggressive about raising interest rates. Nobody knew that COVID existed at this point in time. And, a month later, COVID hits and the Fed is forced to bring interest rates down to zero to try to keep the economy going, which is what they did. They kept rates at near zero until the end of last year or beginning of this year, and maybe a little bit too long, frankly. And if we were looking at this chart in January of this year, you would have seen a much smoother path. They intended to get rates up to 3.5 to 3.25, but over the course of this year, next year, and into 2024. And when February came and Russia invaded Ukraine, China shut down Shanghai, that sent everything into a tailspin, and the Fed had to essentially rapidly increase the pace with which they intend to get rates up. They intend to get us there pretty much by the end of this year. So next chart, the next couple of charts, I'm going to talk about a couple of things related to the economy, very important relationship to the economy, and positive for the most part, right? So inflation's bad, rapidly rising inflation is bad. The Fed raising interest rates is what needs to happen to get control of that, but the markets don't like it. But it is important to understand that the economy is in pretty solid footing. The labor market, which is really important to the overall broad economy, is very strong right now. As I mentioned, we have more people quitting their jobs than ever before. Now, that's not necessarily good, but you don't quit your job if you're worried about your financial security. So that will probably slow down. People will probably hang on to jobs as we go through this slower economy or possible recession. But job layoffs are very, very low. This will get worse, right? We already know, particularly in the tech industry, companies are announcing that they're either freezing hiring or starting to do some layoffs. But they're doing that from an extremely, extremely strong labor situation. So yes, some people will lose their jobs. The unemployment rate will likely go up, but from an all-time low. The next chart looks at the real estate market. The real estate market is also really critical to the health of the economy, and we've been in a very strong real estate market for the last several years, really coming out of the financial crisis. So good and bad here. On the bottom lower right hand side of this chart, you see the people who are taking out mortgages have very high credit quality. They can afford to pay those mortgages back. That's really important. When we went through the financial crisis in 2008, that was not the case. People were getting mortgages that they really couldn't afford. And that was a huge part of what caused that crisis. So bank balance sheets are strong, consumer balance sheets are pretty strong. Housing inventories are low, and that has driven prices up. So if you're a homeowner, that's been good for you. If you're a home buyer, that's not great. And we will probably see in certain pockets, housing prices come down a bit because of that. But also important on the upper right or left hand side of this chart, mortgage rates. So mortgage rates have come up because the Fed's been raising rates, but they're still at really historic lows. I remember refinancing my first mortgage down to a 5% rate. If your perspective is the all-time low of 3% interest rates, then yes, 5% seems high, but it's on a historic basis, still a reasonably good time to go buy a house, borrow money that you can afford to pay back at a 5% debt rate. The next chart looks at consumer confidence. So the consumer is also a really important part of the overall economy. Consumers are what drive it. Consumer confidence reached an all-time low in June of this year. Surprising to me, lower than it was in 2008, which was a pretty horrific time. And this is good news. And it's good news because we tend to see the stock market rebound when consumers and investors are feeling the worst. So this is a counterintuitive indicator, but if you look at the trough, the various different lows that we've reached in consumer confidence, going back again to the 70s, the average market return following that trough was about 25%. So we have seen a pretty significant recovery in the market since June. I'll talk a bit about whether that is sustainable or not, but the good news is bad consumer confidence tends to generate strong stock market returns. Next chart looks at what I would call good and bad news, or just some interesting data. On the right-hand side, we're looking here at spending, personal consumption, and the top lighter blue line is what we're spending on services, and the bottom darker blue line is what we're spending on goods. And probably not a surprise here, when we reached the pandemic, our spending on services dropped precipitously, but it has now recovered back basically to where it was pre-pandemic levels. Our spending on goods, of course, shot up during the pandemic because that's all we could spend our money on, and we were home ordering things. And that has started to move in the other direction. So we've had a definite shift in how we're spending our money. And that all makes sense. And this is good news with respect to inflation, because we're starting to see consumer spending normalize, if you will. The left side of this chart is a little concerning. This is looking at our personal savings rate, which is the yellow line, and the amount we're buying on credit, which are the blue bars. We are spending a lot less, we're saving a lot less right now than we have been historically, and we're spending more on credit. And this is something just, to be aware of and concerned about. If you buy something online today, when you go to check out, you're given an option. Do you want to pay for this in whole, or do you want to pay for this over the next 12 months? And it's not about offering you a credit card. It's just that the companies are now saying, we'll take partial payments for this. And that is really, really not a good thing. And so this is something we've got a close eye on, because if consumers get into too much debt, that's when we start to see, again, an impact on the economy, bankruptcies. If consumers aren't saving, they're not saving for retirement, they're not able to supplement their futures. So I would call this certainly a bit of a red flag on the left-hand side of this chart. So what does this all mean for the stock, or for the markets, the stock and the bond markets? We'll talk about both. The bond markets are usually pretty boring and get ignored, although it's a huge part of the market. But I'm going to talk about it more than I normally would, because all of this has had a significant impact on the bond market as well as the stock market. The next chart looks at the S&P 500 return, calendar year returns going back to 1980, are the dark bars. The red dot is the decline, the biggest decline experienced at any point during that calendar year. So a couple of important takeaways here. Number one, the markets drop at some point almost every year. And on average, that decline is about 14%. So when we see the market down 10, 12%, it really doesn't ruffle our feathers much, because it's kind of normal. And those kinds of declines oftentimes are very short-lived. We've had a decline this year, you see, at its worst point of 24%. So that's much more significant, certainly more than your typical correction. A decline of more than 20% is sort of erroneously determined or called a bear market. So you can argue or justifiably say that we are in or have had a bear market. But where we sit today, the market's only down about 9 or 10%. So we've, from this negative 24%, which was reached in mid-June, to today, the last couple of months, the market's earned back quite a bit, more than half of what was lost at one point. Now, we could retest those lows, right? It doesn't necessarily mean this is all behind us. I'm pretty optimistic, but there are a lot of things that could push us back down into that territory that we were. But certainly we've come a long way to recovering in a pretty short period of time. Also important on this chart are the last couple of years. So 2021 was sort of a fascinating year because it was the continued recovery from the pandemic, and the stock market went through the roof. We had a 27% return on the S&P 500 and almost no downside volatility. It was sort of the dream year, the year you want to happen in the markets. But there really wasn't any reason for it. It was just, there was a lot of money sloshing around the system. Companies were buying back shares. Investors were investing money they had. So it was probably a higher return than is really justifiable. And what's happened in 2022 has sort of reversed that and kind of what markets naturally do. The next chart looks at what I will say is good news. This is looking at the price to earnings ratio of the S&P 500, which is a measure of stock market valuation, how expensive stocks are or cheap. And the average PE ratio over the last 25 years has been about close to just under 17. We reached a point post-pandemic in 2021 after stocks had gone up so much where stocks had gotten quite expensive and they got repriced, right? So we're now back to a point where stocks are pretty reasonably valued where we sit today. If earnings are stable. So it is important to note that this ratio of price to earnings is the current stock market price of a company versus the amount of earnings that they're making. If the earnings decline, the PE ratio will naturally go up. So part of the reason the stock market has recovered so much since mid-June is that second quarter earnings came in better than expected for the most part. And there was a lot of concern that everything going on in the economy slowing, inflation rising, that was going to have a really negative impact on corporate profits. And it really didn't, and not as bad as it could have been, of course. And so that's why the stock market has gone up. Now, if we start to see the earnings trend down, that's going to be bad, and stocks will once again be expensive where they are today, and we could certainly see the market, trend downward again. The next chart looks at something else that is important to understand about the S&P in particular. So if you look at the S&P, it's an index of 500 companies across all different industries, weighted to sort of mimic the broad US economy. The top 10, the 10 biggest companies in the S&P 500 are companies we all know: Microsoft, Amazon, Apple, Facebook, now Meta, Google, now Alphabet, companies we all know. these companies have become enormous. The stocks have done very well in the last decade, and these companies, the size of them is just, it dwarfs everything else. And so the S&P index, because it's weighted by market cap of the 500 companies, has become very concentrated in those top 10 names. So if you look at the upper right-hand side of this chart, you'll see that the 10 largest companies in the S&P make up 30% of the market cap of the index itself. It dwarfs the other 490 companies. Now, bottom, just below that, you'll see that they are contributing a large amount, 19% of the earnings to the S&P 500, but there is now kind of a mismatch between how much they're contributing in earnings and how much their market cap represents, which is a challenge for those companies in particular. And then on the left-hand side, you'll see that those 10 names, those companies, are quite a bit more expensive than the broader number of companies in the index. The current PE ratio of those top 10 is close to 30 versus 15 for the other 490. So the index itself has some structural issues that can happen from time to time. It doesn't happen that often. We haven't seen this much concentration in the index since the early 2000s, which of course was what led up to the tech bubble bursting. Don't take that as a prediction, just an interesting anecdote. The next chart looks at similar data for the bond market. So here we're looking at the calendar year returns of the bond market as measured by the Barclays Aggregate Bond Index, and a red dot showing that, yes, we do get a little bit of fluctuation in bond returns every year, but not very much. Generally speaking, bond returns are positive. Bonds are essentially debt. You're lending money to the government or to a corporation or to a municipality, and they're going to pay you an interest rate for that. And so generally speaking, this is not risky business, but when interest rates rise, bond prices drop. They move in the inverse direction, and interest rates, you can see this year, of course, have gone up, and that has had a very significant impact on the bond market, and it has dwarfed the other few tough years for the bond market. 1994 was the last time we had a significant and quick increase in interest rates. The Fed raised rates 7 times that year. The aggregate bond index was down 7% at its worst point, but ended the year down 3%. We've had almost twice as much downside volatility in the bond market this year, and that is because of the pace with which the Fed has been forced to raise rates. The next chart explains a bit about one before that. Yep, there you go. A bit about the relationship between bonds and interest rate increases and the length of time that the bond matures. So the takeaway here is, if you can buy a bond that matures in a year or in 30 years or anywhere in between. And if you buy a 30-year bond, in theory, you're supposed to get a slightly higher interest rate because you're giving up money for a longer period of time. But if in that 30-year period, interest rates rise, and now the interest rate you're earning on your bond is lower than prevailing interest rates, nobody's going to pay you much for that bond. It's going to drop in price by a lot more than a bond that matures in a year, when that money could then be reinvested in the higher rates. So duration or time to maturity of a bond is really important, particularly when interest rates are rising. The longer the bond duration, the bigger the impact of rising interest rates. I'll talk about the Community Foundation portfolio shortly, but just to give you a preview, we keep duration around 3 to 4 years in that portfolio. So you're on the much lower end of impact of rising rates in the portfolio. So the next chart is the last one about the markets, and then I'm going to talk about the Community Foundation portfolio. But the media's got to fill newspapers and 24-hour news cycle, and so they've really spent a lot of time in the last couple of months talking about whether we're in a bear market or a correction, and whether or not we're in a recession. And I will argue that we're in a bear market, or at least we had a bear market. The market fell more than 20%. So we are a little red line at the bottom of this chart. but important, and I will also argue it doesn't really matter if we're in a recession or not. It matters, of course, for those people who might lose their jobs or who are going to be directly impacted by a bad economy. But from a stock market perspective, recessions are lagging indicators. The stock market is looking ahead and looking at what's coming. So the decline we had in the first 6 months of this year may well have been the market anticipating the recession that we may be in or that may be coming. The market is generally going to recover long before the economy does. There's a big disconnect between those two things. The other really important takeaway from this chart is that, yes, we have bear markets. I think when markets are falling, it's good to have some context so that, you know, we don't just feel like we're in a black hole and we don't know where the end is. On average, in what I would call the modern economy, so the mid 60s to now, on average, in each of these bear markets, the market has dropped by about 37%. So, you know, if you allocated 100% to stocks, that might be your experience in a portfolio that's not diversified, but only owns the S&P, that would be your experience. But you can see that if you stayed invested, you would have that would have been followed by a bull market. Bull markets tend to last much longer than bear markets. The market goes up 75% of the time. So we had a 24% decline in the S&P so far this year. We've rebounded from that. But if things get really bad, if the economy really does slow from here in a significant way, and corporations are earning significantly less, how bad might it get? We might retest those lows that we saw in June. It could get worse, right? We might see something as bad as a 37% decline in the market. We allocate 60% of the portfolio to stocks, so the decline in the portfolio will certainly not be anywhere near that level. So it is important, I think, to put context around markets. They do fall. They also recover. The declines can be really scary, and our job is to make sure that we don't make emotional decisions around investments. It's best to keep the emotions at bay, stay invested for the long run, and keep a long-term perspective. So the next chart looks at the Community Foundation portfolio going back to early 2016 when we began working with the Community Foundation. At that point in time, there was about a little bit less than 16 million in the portfolio. Marianne and her team have done a fabulous job, along with you all, of getting contributions and donors to put money into the Community Foundation, as well as putting that money out into the community. So the lighter blue line looks simply at money coming into and leaving the portfolio. So think of that as had you kept it under the mattress in cash, there'd be a little more than 21 million in the portfolio today. Because it's been invested in a disciplined way, there's actually about $12 million more than that is just pure investment gain. And that's really our objective, is long-term to be able to maintain or grow the value of the portfolio, all while money is coming out of it to go into the community for good. And we take that very seriously, along with the Community Foundation team, and we do have a long-term perspective on all of this. There's some jagged lines at the top blue of this blue mountain chart, right? I mean, we had the quick and steep decline when COVID hit, and then the recovery back from that in 2020 and 2021, and then the correction we've experienced here this year, and some recovery back from that. It is important to note that if you normalize this for distributions going out or contributions coming in, you're still, quite well ahead of where you would have been before the pandemic hit. So and this isn't a really long-term, from a stock market perspective, long-term is 20 plus years. We don't have 20 years of time together yet, but even this is a reasonable period of time to be able to kind of understand what you should expect from the portfolio in the future. The next chart looks at how the portfolio is invested. So, and this, I will say, this is really based on what is expected for portfolios that have a similar objective: long-term time horizon, reasonable distribution level, objective to grow the assets over time. We've allocated 60% of, roughly 60% of the portfolio to what we call risky assets, the stock side of the portfolio. Starting at the top and moving counterclockwise, we've got, foreign stocks in the portfolio as well as US. We are underweight foreign, and will likely continue to be underweight foreign. Although I will say foreign stocks have outperformed US stocks this year if you take currency fluctuation out of the equation. Now, currency is important. It has an impact on stock returns, certainly, but a lot of folks think that it's been just a devastating market for foreign stocks, and in general, it really hasn't been as bad as we might think. But the world economy is made up about half US, half foreign. We don't want to have half the portfolio in foreign stocks. We keep about a little bit less than a third in foreign stocks, so we're definitely underweight, but they are a really important component of the world economy. On both the US and the foreign side, it's important to note that this portfolio is very well diversified. So I spent a lot of time talking about the S&P and about the aggregate bond index. The S&P is one index representing really the US large cap market, and it's much more growth oriented right now because of the overweight of some of those big growth stocks. But there's a lot of other really important companies and industries in this economy, namely cheaper stocks, cyclical companies, banks, industrial companies. You'll get more of those in the value end of the spectrum. So you see there's an important allocation to US large value stocks and small value stocks and foreign large and small value stocks, in addition to the growth side of the spectrum. On the bond side, we are really trying to get as much stability out of the bond portfolio as possible. You don't want to take a lot of risk in bonds because you're just not going to be compensated for that over the long run. And we've seen that this year. Anybody who went out to a longer duration trying to eke out a slightly higher interest rate was, taken down at the knees this year when interest rates rose. We want to avoid that to the extent that we can. So we're taking as little risk as we can on the bond side, and we think of that as the ballast against the stock market volatility. So the next chart, second to last, looks at how the portfolio has performed since we've been working together. I ran this through August 12th, so it's changed a little bit since then, but not meaningfully. From June 30th through August 12th, the portfolio had recovered back about 6.5%. And on a year-to-date basis is now down a little over 7%. When we met with the committee in July, looking at the first half numbers, I will tell you were down closer to 13%. So pretty significant recovery so far, which at least gives us a moment to breathe and feel a little bit better. On a long-term basis, this portfolio, longer-term basis, at least since we've been working with you, its portfolio has earned a bit north of 7%, which is very consistent with the broad markets and what they have provided in returns over time, and quite consistent, I would say, with what we would expect on a much longer-term basis from a portfolio designed like this. Lastly, I'll leave you all with and I'm happy to take questions, but I'll leave you all with just a really important concept, particularly when markets are volatile. And I heard a client say this to me yesterday, told me his really smart friend had told him that it was a good time to be in cash. And I said, maybe not, who knows, but that's a risky thing to do. And how long has your smart friend been out of the market? He said, for a couple of months. And I said, that's unfortunate because he's missed out on so much of the recovery that's already happened. And when markets recover, it tends to happen quickly and in a couple of big days. And if you're not invested on those days, if you've decided to kind of wait on the sidelines and just keep what you've got until things feel better, you can really, really negatively impact your longer term returns. So this just looks at, missing, if you're invested in the S&P 500, your average return over the last 20 years has been about 9.5%. If you missed the 10 biggest days, your return's almost half as much. And that more than anything will impact, again, a portfolio like this. How much money can go into the community? How can you maintain the corpus of the assets over time above an inflation rate if your return is half what it should have been because you missed a couple of days? So we are here to remain disciplined and make sure that the portfolio is allocated in a reasonable and prudent way to achieve those objectives. There are going to be years where the market is down, but we've got to ride through those, rebalance, take advantage of them when we can, and just keep a steady head. So I'll stop there and take, if there are questions, happy to answer them. I think if you have them, go ahead and put them in the chat, and Melissa's going to monitor that and read them off.
So Jennifer, there's a question around the recent forgiveness of loan debt. Is there anything that people need to be apprised of in regards to that?
Yeah. So for those who may not be aware, Biden signed a bill that forgives student loan debt for certain people. So it's for people who have individuals who have income under 125,000 or couples under 225, I think, or 250. So it's not for everybody, but it is major, right? So what does that mean? It's stimulus, really. I mean, basically saying the government loans you money, the government, and it's limited, by the way. It's up to $10,000, I think, for an individual, or 20,000 for a couple. So it's limited. It is a stimulus. It is essentially the government saying, we gave you money, we lent you money, and now we're not going to make you pay it back. And is that going to impact the economy, or how will that impact the economy or the markets? I think it really won't impact the markets that much. It's not the kind of size of anything that it's going to have any major impact on the market. It is stimulus. So these folks now have $10,000 more than they otherwise would have had. That's more money for them to spend on other things or to save, right? So it'd be really good if they could afford to save that money. We are in this tricky spot where we've got inflation, and you've got the Federal Reserve actually trying to tighten the economy, or tighten monetary policy. And then on the flip side, you've got something that actually is a stimulus. So those kind of work against one another. But again, I think the overall impact is going to be quite minor on the economy. It could be major for some of the folks who will have that extra money that they can choose what to do with. But again, also remember, if your loan for $10,000 is forgiven, it's not $10,000 more you have in that particular year to spend. It's $10,000 over the life of that loan. So that's why I say the dollars we're talking about in the grand scheme of the overall economy are quite small. And so I don't think it's going to really move the needle one way or another in a major way.
Okay, and then another question. What do you sort of, if you could just glean it down into a couple sentences, what do you see happening through the end of the year?
So as I've mentioned, we've already had quite a significant recovery. The most important things to come will be the future inflation reads. The last one we had showed inflation starting to move in the right direction. If we continue to see that kind of data, I think the markets could continue to recover. Third quarter earnings, which won't be out until October, are also going to be really important. And if consumers are spending and companies are continuing to earn profits, again, market probably starts to recover. There's always this sort of the black swan thing. COVID was one of them, something that we just isn't even on anybody's radar. But I think from an economic perspective, Corporate earnings and inflation are the two most critical things right now, along with the Fed, and that's going to drive what the Fed is doing. And the hope, and everybody's fingers should be crossed, that the Fed isn't too aggressive, such that it does send the economy into a recession that maybe isn't necessary at this point in time. So generally speaking, I'm pretty optimistic. We think that we probably close 2022 with still probably a modestly negative market, but not the negative 24% where we were, and probably not even quite as negative as where we are today from the beginning of the year.
Perfect. Hence your slide about staying in the market.
Yes.
Hanging in there. Okay, Jennifer, thank you so much. We appreciate you being here. I got another question for you. Any thoughts around the next Fed move?
Yeah, so the Fed will raise rates again in September. The big question is how much, right? And I think if we, based on the CPI numbers we've seen, and if we see another number similar to that, we probably get a 50 basis point increase by the Fed in September. There is a probability it's another 75 basis points. If it's 75, I think at this point the market might get a little volatile around that, might think it's a bit too much. But the market's fully expecting that they will raise rates in September by at least 50 basis points. And if we get some short-term volatility around a 75, market volatility around Fed moves is typically, fairly short-lived. I think the market will then quickly start to look at what corporate earnings in October start to look like, and that'll become more important. So the Fed will raise, but 50 or 75 is the most likely.
Okay, great. Any last questions before I hand it off to Marianne? Okay, I think we're done with the Q&A. So
thank you,
Marianne, back to you.
Thank you, Melissa, and thank you, Jennifer. I hope you all found that as rich as I did. And it gives you a sense of the robust sort of conversations we have at the Stanislaus Community Foundation around our collective charitable assets under management. I do want to end our call today with just a brief overview of our own initiative. So obviously, a lot of our donors are out doing great work in the community vis-a-vis their funds here at the Community Foundation. And those of you that are professional advisors that may have not worked with us in the past, what we always say to both you and your clients is you're not giving to the Community Foundation, you're giving through the Community Foundation. That's certainly our donors' experience, is they're out there providing grants and scholarships around the causes that are of interest to them. At the same time, the Community Foundation has our own leadership work that we engage in around these 4 pillars. We really believe that our community, in addition to supporting a really incredible community of nonprofits and all the programs and services offered there, that we really can, using philanthropy as a tool, but also our own leadership, we really can improve the education in our community. And that's through the Cradle to Career Partnership that we launched, as well as through all the scholarships that are given out. We also focus on economic opportunity. And right now we're at the tail end of a significant initiative called Stanislaus 2030 in partnership with our Stanislaus County Chief Executive Office and local business leaders and education leaders, really focused on creating an economy of the future that is more resilient and more robust. We're also engaged in civic engagement. We have a group of young leaders. We just actually launched the 2nd cohort. These are emerging, incredible leaders, and we place them on 2-year terms on local nonprofit boards, but we also provide them training, curriculum, coaching, so that they can really engage in our community and our nonprofits. We also fund several local journalists. We do believe that community and journalism, especially in a community like ours that's considered a media desert, is very critical. So we've made investments through our media lab to really bolster community journalism locally. And then our philanthropic innovation, in addition to the work we're doing to support our donors, we have a new nonprofit directory that you may have heard of. It's Candid, which was formerly GuideStar. So if you go to our website, you will see nonprofit information. This is nonprofit data that nonprofits themselves have uploaded. And so you can search, there's a taxonomy, you can search by sort of services offered, geography. There's a lot of different ways that you can really use that tool to learn more about local nonprofits. And that information is constantly getting updated by those organizations. A really good tool to share with your clients too, or the donors that are on the call that are wanting to do some research. Again, you can search by type of area that local nonprofits focus on, whether that's homelessness, recreational services, youth serving organizations. There's a lot of different information on that nonprofit directory. So I did want to share some of the work that the Community Foundation engages in, but obviously all of this is important to us. We are here to support local donors and certainly folks that want to do good in our community. So just wanted to really sort of uplift how seriously we take our charitable assets under management. And with that, I'm going to turn it over to Melissa just to wind us down. And yeah, thank you, Melissa.
So that's about it for us today. I want to thank all of you for taking time out of your afternoon to learn a little bit with us, hear a little bit about the markets, hear how our family of funds are invested so that there is long-term charitable impact. We are going to be sending the slide deck out, as I said earlier, along with a survey. So we would really appreciate your feedback on the survey. And whether you are an advisor that's on this call that is interested in learning more about us, I am more than happy to talk to you and share with you the host of funds that we have here that are available as solutions to your clients. And for those of you who are donor advised fund holders, we're grateful that you've chosen to make your charitable impact through the Stanislaus Community Foundation. And we are available to help you as you sort of think through your charitable goals and what you hope to accomplish and what you'd like your legacy to look like. So thank you everybody for joining us today and have a great rest of the week.